Bro, I'm done, bro. I'm done. I see all these cats on YouTube, on IG. They're over here flexing, doing all this stuff. They flashing Lambos and they flashing Hummers and all kind of crazy cars, Ferraris. Man, I'm driving my truck. What's going on, man? It's like, maybe I should start flexing too. You know, I be catching them real pips. Most of these cats don't even be catching no pips. Maybe I should start flexing too. I start wearing multiple watches. Maybe I start rocking the big clock chains. What you think? That'd be crazy, man. Maybe I should start flexing on these cats. What you think? You know what? I'm gonna buy a car. You know what? Nah, I'm gonna buy 3 cars. Nah, bro, you know what, bro? I'm gonna buy 5 cars this year. What's up? In fact, let's go buy one right now. Bro, tell me, you know what I'm saying? I know what I'm talking about. I know what I'm talking about. My wallet stays with it, right? In fact, you know what? Here, one for you, bro. How about that? Man, look. Look at all that money. Look at all that. What, you want some more? I'll pull that out of a box too. Look at this. Now, you know how much money I got? I just gotta get it out the package, hold on. 10 racks. 10 racks out the package. I got a good relationship with the Federal Reserve. Man, I live and breathe money, man, shoot. These guys out here flexing. It's time for me to flex, man. It's time for me to flex. So now, you know what I'm gonna do, bro? I'm going car shopping. What you think, man? Should I get a Lambo? Maybe a Lambo? Ooh, maybe I'm Italian. I'm gonna get a Ferrari. What you think, man? I got ooh, money coming out my head, man. Look at this. Ooh, I should get a Ferrari. That's what I should get. I'm kind of big for a Ferrari though. Maybe I should get one of the new Redefining trucks. Them boys 700,000, got bomb defense. You know, I don't trust these folks out here. Maybe I'll do that. I think, ooh, what about a Maserati? That's kind of dope. That's kind of dope. Maybe I'll get one of those. Yeah, man, it's time for me to flex, man. It's time for me to flex like I see everybody else do. You know, if I grew accounts, I'm trading big money, so it's time for me to flex too. Watch this. Luxury, man, that's what I'm talking about. Lambos, BMWs, man, they even got them Alphas up in here, bro. Look, I'm going in there cash. Let's make something happen. Cash. Let's get it. All right, man, let's get it, bro. Lambos and BMWs, that's what I'm talking about. Flexing on them. Actually, you know what, bro? I need to do it right. Let's go over here, bro. Let's go over here. What's going on, everybody? It's Joe Giunta with Trend Trading Academy. I'm here to help you trade and get paid. And guys, I know you see me acting out of character, see me acting crazy out here talking about these Lambos and all this stuff, but you know that's not me. I just wanted to kind of bring you a perspective today because I feel like we're being lied to. They're giving us half information. Anybody can show you a sign that says luxury, a sign that says Lambo, a sign that says BMW, but they're not showing you, man, this place sells Chryslers and GMCs and Nissans too. You know, they only show you what they want to show you. And I'm just telling you, these cats out here flexing, don't let them make you feel some type of way. Don't let them make you feel like you're not successful because you're not driving a Lambo. Let me tell you something. I've traded 7 figures and I drive a Chevy truck. I don't need Lambos and I don't need Maseratis and I don't need all this fancy stuff to prove to anybody who I am, because I know who I am. And I do this for my family. I do this for my future. I do this for my city. I do this for my church. You guys know my why. If you don't know why, why you're doing this in the first place, it's going to be easy for you to get caught up in all that nonsense. But if you have already kind of set up why you're doing this in the first place, you're not going to be able to get deceived by all this other stuff. You don't need all that other stuff. That's just somebody out there flexing. Now, it might be that you love sports cars, and you're do your thing. If you love Lamborghinis and you love sports cars, and look, I ain't knocking you, do it. But don't let nobody make you feel some type of way because you ain't doing that, right? What your level of success is about continuity. It's about consistency. Success is not a destination. It's not because let me tell you, when you arrive at what you call success, are you done? You don't want nothing else? You're done? No, you're going to get there and you're going to want something else. It's this never-ending pursuit of more, right? But when you understand in the beginning what your why is and what success is, then guess what? Success is the fact that I'm pursuing everything I came for. Success is that I don't quit. Success is that I never give up. Highs and lows, because all of us have them, just some of us don't show them. So what I'm trying to help you understand today, guys, is this stuff is all crazy. And I know we did the little video with, we showed the budget lot and we goofing off a little bit today. I don't want anybody to feel bad. If you were shopping at a budget lot, good for you. That means you're smart with your money. If you're shopping, trying to get, lesser expensive things, good for you. That means you're good with your money and you're fiscally responsible. Shop and spend within your means. You don't need to show off for anybody else. You don't need to have what anybody else may have, because half of them are not really living within their means anyway. They're out there leveraging their credit. They're out there leveraging loans that they can't afford to pay. They're out there borrowing from mom and dad and whatever else, and they got all kinds of crazy stuff going on. They're in debt over their head just so they can get on a YouTube video and flex showing you they got a Lambo. Come on, man. That's silly stuff. Success is the journey. And success is when you just never quit. You never give up, because your why means that much to you. So today, let's talk about how to grow an account the right way and not get caught up in trying to keep up with everybody else. All right. So let me show you how you can take a small account, medium account, a large account, whatever that is, wherever you're at right now. And I'm going to show you how to grow it the right way. Let's get to it. All right, guys, so let's jump into it. How to grow your account the right way. We've talked about all the wrong ways, all that flexing, all these over-leveraged accounts, people trading with, $500 lot sizes when they got a $10,000 demo account or something, with a 1 to 500 leverage, 1 to 1,000 leverage. Like, people are just over-leveraged. They're flexing just to get you to join their companies and things like that. That's nonsense. Now, other people will tell you that you just should take a flat lot size, and that, always take a $20 lot size, always take a $1 lot size, always take a 10-cent lot size. That sounds, good, but it's actually not good. And I'm going to tell you why. I'm going to show you how to grow your account the right way, okay? So first things first. Step 1, determine your account risk percentage. Now, I didn't say lot size. I said risk percentage. Think about this. If you risk 1% in every trade you take, that means that essentially 100% of your account divided by 1% equals 100 trades. Now, obviously, there's broker fees and commissions and things like that. Essentially, for you to blow your account, you would have to lose about 70-something straight trades. You would literally have to lose 70 trades in a row to blow your account, with fees and swaps and broker fees and commissions and whatever else, spreads. But the truth is if you're losing 70 trades in a row, then your problem isn't risk management. You just don't know how to trade. So there's a whole different problem we got to talk about for a different video. But what I am telling you is that if you use 1% risk in every trade you take, you would have to lose 70-something trades in a row to mess up your account. So think about that. When I see somebody say, I took a few losses and blew my account. Well, if you blew your account, how many trades did you take? Did you take 100 trades last night? Did how many trades did it take you to blow your account? Oh, 2 trades. You went the wrong way on me. Well, you were vastly over leveraged to begin with. You shouldn't have been in a position that large anyway. If 1 trade or 2 trades or even 10 trades blows your account, you've done something completely wrong concerning your risk management. So here's what you're going to do. How do we fix that? Trade 1% of your account in every trade you take, and let that be the rule and not the exception. Don't do 1% now, win a couple of trades, see it go well, and then turn it up, right? Proper money management for this technique says to trade with the same percentage in every single trade. Don't change it up. Even after you have a lot of money in your account, stick with 1%. Step 2. How do we figure that out? Well, your total account size. So let's say you have a $1,000 account. You simply divide that by 100. So whatever your total account size, if you're starting with a $500 account, 500 divided by 100. If you're starting with a $1,000 account, 1,000 divided by 100. And that will give you 1% of your capital, because dividing anything by 100 gives you 1. Okay, gives you 1% of it. So example would be if you're starting with a $1,000 account, divided by 100, that shows you that your risk should be $10. You should have a total risk of $10, not $10 lot size, a total risk of $10 in every trade you take while you have $1,000. A shortcut is simply to move the decimal 2 places, and you see where 1,000, boom, boom, that's $10, and that's a shortcut. So step 3, now that you know how much money you should be risking, let's talk about the next step. Step 3, determine your stop loss pip count. Now, this is, and I'm going to tell you, this is where it gets a little confusing, because this is where work comes in. You cannot just have a flat rate of 20 pip stop loss every time you do it. 5 pip, 10 pip, whatever you are. You can't do that, because market structure dictates a different stop loss level at every trade. And if you are trading at a 20 pip stop loss, but you're in a scalp that only requires a 5 pip risk, well, guess what? You're opening yourself up to much more loss than you should. And if you have a 20 pip stop loss, but you're in a trade that's more of a swing or a larger position trade where you need a 40 pip stop loss, because that's where market structure shows, then you're cutting yourself short. And what's going to happen is you're going to get stop loss hunted. Your stop loss is going to get hit, and then the trade's going to go in the right way because you just had it set too tight. So what do? You need to look at market structure, look left on your charts, and see, where does structure make sense? Where do I have the most recent structure that could be tested? And you want to set your stop loss just outside of that structure. If you want to see more about that, I want you to watch the video above on how to use a trailing stop, and I'll go into that in that video. So this should be determined by your trade strategy, market structure, and by looking left to previous levels. Step number 4. Now this is where we get into the money, right? Your total account risk. That's what we got in the first step, right? $10. Your total stop loss, which is what we just got, how many pips is in your stop loss, will tell you what lot size you should take. So if you have a $1,000 account, let's just say, and you are risking $10 and you have a 10 pip stop loss. Let's say you did your markups on your charts and you need to set a 10 pip stop loss. Well, guess what? $10 risk, total risk, divided by 10 pips in your markets equals $1. So that tells me that in this particular setup with a $1,000 account and a 10 pip stop loss, you should be using a $1 lot size, which is a 0.10 lot size. That is how you will make sure you use good risk management. This should be calculated for every trade you take. Before you even step to the markets, you ought to know how much money is in your account, how much 1% of it is, now that you're looking at the charts, what is your stop loss, and you should know how much your lot size is going to be in each trade you take every time you get in the markets. And when you do that little bit of extra preparation work, you're setting yourself up for success. It's like when you go in a house and you're painting the walls. If you just start putting paint on the walls, you're going to have mess ups. You're going to have blotches. You're going to have problems all over the place. But if you properly prepare your surfaces, make sure that you patch the holes. Make sure that you do your prep work. Your paint can go on and look beautiful like a brand new wall. But you cannot expect to put a new product right over a messed up wall and expect it to look beautiful. You're going to still see all the problems because you skipped over the preparation it takes to make a beautiful product. If you're cooking and you just throw a steak in the pan and that's it, you just hope for the best, turn it on high and hope for the best, it's not going to be a very good steak. But if you take your time and season it and marinate it and let it sit and let it rest and then prepare your pan, let it heat up properly and cook it, you understand what I'm saying? Preparation. That's what sets you up for success, okay? Now, this should be calculated for every trade that you take. Step 5 is the compounding. So, as you can see, I got my calculator up on the screen, and as you can kind of see here, what I'm telling you is if you start with $1,000 account, and that's just kind of what I'm showing you. You can figure these numbers out for yourself. But if you start with $1,000 account, it doesn't seem like much because when you do that, plus 2%, okay, it's only $20 is your first trade. And why do I say 2%? Because everything that you do should have risk reward in your favor. If you risk 1%, your reward should be 2%. You shouldn't be taking a risk reward trade of 1 to 1 or 1 to less than 1. And that's a whole nother video for another time. I want you to make sure that you go and look at my risk management videos where you can see where I talk about risk to reward being in our favor. I don't want you to take trades where there's more risk than there is reward. You should always have reward in your favor. So for me, I take trades that are a minimum of 1 risk to 2 reward. 1 to 2 risk to reward. So that means if I'm risking 1%, my potential gain is 2%. So that means if my risk is $10, my potential gain is $20. You see how that works in my favor? And if you set that up, watch this. If you go from 1,000, risking 1%, $10, gaining $20 on your trade, you will see that your first trade will end up with a profit of $20, but with $1,020 total account size. Okay? Now, if you look at it again, you see where you have $20 now becomes $20.40. And I know that doesn't seem like much. I'm only making 40 cents more in this trade than I was in the previous trade. But now you're at $1,040.40. And of course, there's broker fees and commissions and all that kind of stuff. You can calculate that with your own broker. But if you continue to do this, you're going to see where this adds up really fast. Just watch this. Now you see, guys, look at this. This is 104. So let me just explain. I know there's losses. I know this kind of stuff, but watch this. If you win 104 trades, so think about this. This is not where you're trading all day long every day. This is not where you're trading and staring at the charts all day. This is simply taking 2 trades per week, not per night. Not per minute, not per hour, not per session. 2 trades per week that win. That's not hard. Go look at our trade setups in TTA. We're giving you sometimes 3 trades in a night that win. Okay? So it's not hard to get 2 winning trades a week. You get 2 winning trades a week over the course of 1 year, 52 weeks. guess what? That's 104 wins. If you have 104 wins using this method of 1% risk, 2% reward, compounding it this way, in 1 year, winning all the trades, you can have $44,278.43 in your account. Now, you say, man, you're just fudging the numbers. We might lose. Okay, let's just say you lose a couple of them. Remember, the risk reward is in your favor. So if you lose 1%, you know, you're losing 10 instead of it's not 20 you're losing, it's 10. 1%, not 2%. And that number grows, of course, in time and in compounding. But when you're taking these trades, your reward is bigger than your risk. So let's just cut that number in half. All right? Let's just cut that number completely in half. Let's cut that number completely in half. Okay? Let's just say you did lose some. So you take that number and you just cut it in half. Just take away complete half. That's insane. Now you're not going to lose that many trades. But let's just cut the number in half. If you can turn 1,000 into 22,000 in 1 year and lose a whole bunch of trades, did you do real well? That's awesome. You made $21,000 profit. Literally made your account over 20 times in a year and lost a bunch of trades. You see? It's less about the strategy and more about the risk to reward and the risk management. If you can master risk management, if you can master money management, you can take a 50-50 strategy, something that wins and loses, and you can do really well in the markets. But it's really about making sure you manage your money right. So I want you to do that, okay? I want you to practice. I want you to put it into practice that you are going to use good risk management. You're going to sit down and make a trade plan and stick to it. If you don't know how to make a trade plan, I want you to go to my website, tradinggetpaid.com, and I want you to go get a trading journal. Go get one of my custom self-built trading journals that is built off of my trade plan. Use that as a template, and I want you to go and build your trade plan with good risk to reward and come back to me in a year. And I'll tell you what, you're going to be in profit. You can do this, but it's all about you. It's all about you making sure you stick to risk management, risk to reward, and being diligent and consistent with your efforts. You got this. All right, guys, there you have it. That's how we grow an account the right way. You don't want to get caught up in over leveraging, trying to make more, big lot sizes and all this stuff, because percentage-based growth is going to take you further and more sustainably than trying to over leverage, just, having these big lot sizes. Remember, it's like baseball. Those batters who hit for average, guess what? They get on base a lot. They might not get all the home runs, but they're on base a lot and they score. Those people who are home run hitters, they generally also strike out a lot because they're swinging hard, they're going for it. That's what I don't want you to be. I don't want you to be going for it. And yes, you might hit an occasional home run, but you strike out a lot. And it ends up where it's really not worth it for you in the financial end. So I want you to be methodical, strategic, and take percentage-based growth with proper risk management to the next level. And if you could do that, stay consistent with it. A year, 2 years, that's all it takes. You will compound your account exponentially if you will just stick with it. So now check this out, guys. What I want you to do is I want you to take what you learned today about risk management and proper account growth and pair it with that strategy over here. And that's going to take it. That's everything. Strategy and risk management together. That's how you're going to compound an account for long-term growth. All right. So watch that video. Don't forget to like, comment, and subscribe. I'll see you in the next video.